open and opening types. What do I mean by that? As soon as the market opens, market profile has a very nice way of finding out whether the market is opening in balance or it is opening out of balance. Balance, as you can probably make out, means that both the buyers and sellers are basically equal in their strength and nobody is able to move the market directionally. But if the market is opening out of balance, it immediately tells you that there is a possibility of a big move coming. And how do we find that? Very simple. If the market is opening inside yesterday's range, we call it that market is opening in balance. And if it opens outside of yesterday's range, we call it out of balance. And as soon as you see market opening outside of yesterday's range, you adjust your expectations for the market in such a way that you are now expecting that there will be a big move during the day. The volatility might be high, or you might just get a nice directional progression during the trading day. But if it opens inside yesterday's range, you adjust your expectations as to most likely the today's range will be similar to yesterday's range. So yesterday, if it was a 60-point range, today more or less we will be around 60 point. So these are the expectations. You set them and then you try to match whether the market is really following what you are expecting or not, and then you adjust your trading decisions based on that. Opening basically tells us about the current business the market has to take care of. So opening in case of market profile refers to the first two time periods of the day. All right, first two 30-minute time periods. Now, if the market opens and moves sharply in one direction in the first 30 minutes or first 1 hour, usually people are very happy with that trend and they feel that now market is going to make a big directional progress in the day, and it turns out that market never makes any additional progress. And the reason is that the initial sharp move may have been caused because of trapped traders from yesterday. So yesterday market, like many people feel that market should go down, they come and sell in the market and the market closes, and the next day market opens higher instead of lower. So everybody who sold in expectation of a down move now feel that they are trapped. Market is not behaving as per their expectation and they run for cover. They try to cover their shorts, and that is when you get a sharp rally, which is called as a short covering rally in the markets. And that happens in the first hour because traders are usually anxious. They don't know what is going to happen on the open. They come into the markets and they see that markets have opened against their expectation. They just try to throw in their positions, and that sometimes gives you a very wide range. But you have to adjust your expectations based on what type of business is happening in the market. Is it the old traders who are covering their positions, or is it new traders who are coming into the markets and they are now expecting some new trend to develop? In that case, you want to join them. But if it's an old business, you are better off fading such kind of a move instead of joining them. Okay, now once again, traders have that habit of classifying things into precise categories. Many people make their living based on classifying things into precise categories. Now, according to me, it is a very counterproductive strategy. What happens is that once you classify something, like if this open inside range or open auction inside range, you classify this open, you try to study the properties and characteristics of this type of open, and then you set it in your mind so firmly that if a market opens inside range and auctions for a while, immediately you start thinking that now we are going to have a narrow range day and nothing else is going to happen. And then what happens is you fall into a confirmation bias. What do I mean by that is, you have a set opinion about the markets, which is a very dangerous thing, and now you're trying to find evidence that will confirm your opinion. And more often than not, dynamic moves, sharp moves, short covering rallies, long liquidation breaks, all these happen in the market because of this particular behavior. I can give you 4 or 5 types of opening types and 3 or 4 types of open types, but then what will happen is you will just get stuck with that. You will have a fixed picture in your mind about that open or opening type, and then you will just try to find confirmation for that particular open type in the markets, and you might miss out on great opportunities. So once again, what I would like to tell you is that instead of focusing on strict classifications of different terms, I suggest you start paying attention to how the auction is developing, how the market is developing. Once it opens, if it is opening inside range, you have that expectation it is going to be a narrow range day or an inside day. But then you start tracking the auction, that whether it is really behaving like an inside day, or if it is behaving like an inside day for some part of the day. Are there any subtle signs which are telling you that maybe the market is ready to blast off in one direction? Despite that open inside range and option inside range, you can use order flow charts for that. You can use surrounding context for that, and that will improve your understanding of the market. Keeping in mind all the time all the terminologies is not going to help your market understanding, but it will definitely give you a feeling that you understand market profile very well, and all the data types, and all the structural features, and what anomalies mean. But it hardly matters, because market won't pay any attention to what you know or don't know. So what you should be doing is just use basic principles of market profile, auction market theory, and then try to understand what the market is doing at any particular time in the day, and then adjust your trading decisions or expectations according to that. So if you still want to know what are the open and opening types, uh, I have a glossary in the free course which I just mentioned at the start. You have all the open and opening types in that, so we need not spend time on that. You can just go and read there. But if you want my opinion on that, I would suggest that don't be so strict on the classifications. These boundaries are not clear cut, and there is a reason for that, and just try to focus on the developing auction instead of these classifications. That will really help you in your trading.